just to set the stage a little bit, we all know that regulators increasingly view climate scenario analysis as a useful tool to enable effective modeling of climate risks. And now there are actually several pilot frameworks and methodologies underway to assess climate-related impacts. We'll explore how climate scenario analysis actually takes place, what are the different visions in different parts of the world, including on both sides of the Atlantic, as well as how it might be different from traditional bank stress testing. And we'll investigate its promises, as well as its challenges, including the need to build new sorts of capabilities at banks and other institutions. And given the 1,000 flowers are blooming, which also means there's a lack of a global approach, we'll ask, is it possible to achieve greater international coordination and consistency in climate scenario analysis? To help us with this complicated but important topic, I'm very pleased to have join us Cheryl King, advisor to the Governor of the Bank of Canada, Teresa Lober, head of the Climate Hub at the Bank of England, and Piyush Agarwal, global head of climate risk at Citi. Welcome to all of you.
Thank you.
Let's jump right into it. Perhaps we'll turn to you first, Cheryl, if you don't mind. Give us a sense that in this bold new world of taking on the pathway to a net zero global economy, the transition that is widely argued for, anticipated, and in different parts of the world, and fits and starts, we're moving towards, the particular role of the financial system has been seen as critical in this, and the stresses and strains that may be placed on the financial system as an enabler of the rest of the economy. In this context, figuring out how to do these sorts of scenario analyses has been something of a challenge, and different countries have taken different views. Different central banks have taken different views. At the Bank of Canada, you've actually done some pilots, and I wondered if you could give us some early thinking and results and learning that you've gotten from your early steps forward on this.
Yeah, thanks a lot for that question. It's actually pretty fresh off the press. We published it in mid-January. It took us over a year to construct and bring all the constituent parts together. But I think broadly it provided some really good, important learning lessons. The issue is climate change does pose significant risks to the financial system and to the economy, which is where the perspective of the central bank comes from. We're obviously watching increasingly severe weather events. And then we also are aware that there has to be a transition to a low carbon and net zero economy. This is, of course, particularly an issue for Canada, as it is warming at least twice the pace of the global average. And it's also very resource intensive. And so it also faces a very complex transition. We're aware that decarbonization, creates some opportunities for investment, but we're also very aware that it carries risks. And for the financial sector, mispricing of those risks can expose financial institutions and investors to large and sudden losses. So we engaged in a pilot to understand these risks a little bit better. What we did was we engaged 6 major financial institutions within Canada. Those were 2 global systemically important financial institutions, 2 property and casualty insurers, and 2 life insurance companies as well. The participating financial institutions used the climate scenarios that we created to explore new methodologies to support climate-related financial risk assessment. The exercise in terms of findings was quite interesting. It really highlighted that, we're at the very, very early stages, as you mentioned. There's definitely a need to develop consistent ways to analyze and disclose climate risks and help identify data gaps and awareness of climate transition scenarios on the risks on their portfolios. The scenarios, which we actually tailored to Canada and the US, which is where the bulk of the activity within Canadian financial institutions comes from, was in order to be relevant for Canadian financial institutions, showed us that for the economy as a whole, it's going to undergo some significant structural changes as the world transitions to net zero. Substantial restructuring in many sectors will be required to meet climate targets. And those, of course, include the oil and gas sector, the coal sector, although, there are some winners as well. The results are telling us, for example, that the electricity sector is going to benefit. It was also very clear from our analysis that delaying action heightens the risks to the financial sector and the entire economy.
So that's fascinating. You were able to look across sectors, and a couple of points that you mentioned we'll pick up in the course of our conversation, that there can be winners as well as losers. You had mentioned one sector, the power generation. The analysis that I've seen suggests that in the longer term, it may take some time to get there after cost of transition. There would be perhaps a more stable sort of low carbon energy system that could emerge that could be more profitable. But also perhaps some of the agricultural sectors might see some benefit in your northern climate. Presumably we could look at those opportunities as well. The other point you made had to do with to some degree, the disruption. And I do want us to pick up on this in a bit. That is orderly transition versus disorderly transition and what might be the risks to the financial sector. I do wonder, did your scenarios, you said you handpicked or these were sort of crafted scenarios. Did they consider a disorderly transition as a scenario, or was that beyond the scope of what you were looking at, Cheryl?
Correct. So we had a baseline scenario of business as usual, and then we had three scenarios that we crafted around that. One was a 2-degree scenario, which was basically proceeding along the national determined contributions, that would get Canada to its Paris-aligned goals of 2 degrees. And the other one was a 1.5 degree scenario, which would get you ultimately to net zero by 2050. But then the third one as well is one that you wait quite a bit of time. I think that, in terms of our modeling, we waited until 2030, and then we really had to, pick up the pace in order to get there. And it yielded very, very different results. It definitely had a worse economic outcome. There was more disruption. There was more dislocation of industries, and obviously by inference, jobs and worker displacement as well.
Right, lot to think about there. Teresa, let's come to you. I'm curious, at the Bank of England, as you head up the strategic thinking related to climate change at the Climate Hub, what are the kinds of tools and data that you're utilizing in taking on this challenge yourself there?
Thank you, and thanks very much for having me on this panel. So I think what we really need to tackle this challenge is a whole range of data and tools. And one reason why scenario analysis is so crucial in all of this is that what we typically do with risks, we use data and models that we already have, and all of that is backward looking. But we do know that these risks will fundamentally be different in the future. And so we really need to find a different way of thinking about those issues. What is really important is that, to Cheryl's point, that we need to think about a range of different future scenarios, and that we think about both the transition risk and the physical risk side. Even in the perfect case of like an orderly transition that's well planned and that is coordinated across the globe, we will still get physical risks, and those will impact different regions to different extent. And to the extent that the financial system is global, we'll see that affecting, the financial system in different places, and it will spill over to other countries. So I think we really need to think about a range of different scenarios, and then what the interconnectivity is between different countries and different regions. One point I just wanted to make is I think it's really important to get into the detail here. It's quite easy to look at the aggregate impacts when we think about financial risks, and to think about the risks and opportunities. But I think really when you look at it for different regions, if you look at it for different sectors, you see really quite different impacts. And that's really important for financial firms to take on board. So one key tool I just wanted to mention is the scenarios by the Network for Greening the Financial System. We've actually been working with a consortium of climate scientists to develop these, because part of the challenge for the financial system is they keep saying to us, there's thousands of scenarios out there. Which ones do you want us to use? It's really hard to take climate scenarios as they currently exist and make them relevant for the financial sector, because that translation from the climate side to the economy and then the financial sector isn't yet kind of well established. And so we've tried to work with climate scientists and modelers to provide scenarios that the central banking community, but also the financial system, can build on and make them more bespoke for their own needs.
Great. You emphasized some of the sectoral risks, as I understand it, that you highlight. Is it fair to say, and I've seen some studies that do argue this, that climate change may not ultimately pose systemic risk to the entire financial sector, as the bank stress tests tend to look at, are banks too big to fail, or particular risks likely to transmit throughout the entire financial sector, but rather specific sectoral risks that need to be identified in the course of doing business. I want to distinguish between two sorts of concerns. Do I understand that correctly, or would you paint the picture differently?
So I think we're currently running an exercise at the Bank of England where we're stress testing or doing a scenario analysis with the largest banks and insurance companies. And so we've just received the firm submission. So I think once we have worked our way through those, we'll be able to say a lot more in terms of what this might look like for the UK economy. I think a key factor to consider here is very much how the transition is organised. So which sectors might be winners or losers really depends on kind of how the climate policies that are put in place to make the transition happen, and I think that will determine a lot of what this could look like. I think it's probably fair to say, both from a transition and a physical risk point, we're likely to see pockets of risk. Whether they're systemic or not remains to be seen, depending on how the transition works out. But what we're definitely seeing, and again, this argues to going granular and trying to go a level deeper, is that you might have large firms that are well diversified, and so they might be okay. And then you've got small companies that aren't systemically important necessarily, but might be really exposed to one particular type of risk. And so if they get hit, that could have a knock-on impact. So I think it's really, I think we're probably a little bit too early to say exactly how this might pan out. But just to pick up another point that Cheryl made is, I think that's why it's so important to look at a range of scenarios. It's not just about, knowing what an orderly transition could look like. We really have to understand what this looks like under this orderly scenario, or what if we don't achieve a transition, because this is still a global issue. So even if we get a transition in some countries, globally, we might still see extreme physical risks materializing.
Right. Well, thank you for that. Let's dig into this a little bit further. Piyush, thank you for joining us. Can you give us your perspective? You're obviously in the private sector. You sit at one of the world's largest financial institutions. The distinction between bank stress tests and climate scenario exercises. We saw Chairman Powell make comments to Congress, I think, fairly recently on this topic. How do you see the distinction? And in particular, if you can give us your perspective on what kind of risks, existential or systemic risks, might be posed to banks in the financial sector from climate, as opposed to looking at individual, let's say, counterparty risks or sectoral risks that one might have to manage as a chief risk officer.
Sure. Vijay, thank you very much. And it's great to be here on this virtual stage with Cheryl and Teresa. I think, when you look back and see some of the changes that have come about from the global financial crisis, I think stress testing, scenario design are a cornerstone of risk management. And Citi, like every other large global bank, has been very active in developing this. So the annual stress test that you see, our CCAR submissions, and how we conduct system-wide stress tests are very important for both us internally, but also our regulators and supervisors in assessing capital needs in these stress scenarios. Climate is sort of a new area, but not really. We've been thinking about climate risk for a long time, and there have been pathways of decarbonization through our sign-up of the Equator Principles, through the sign-up of the Poseidon Principles in the shipping area, and also what banks like Citi have done with regard to our own coal policy of gradually providing a glide path and bringing us out of some specific sectors. But given just what we are beginning to see with climate, I think banks have an integral part as a catalyst to a global economy or a local economy. And I think this is where the interest of banks and our regulators is probably hyper aligned. So, how we think about our lending portfolios or underwriting a provision of capital from one part of the economy to another, which is the job of banks, and how supervisors regulate us, I think it's very important that climate stress testing becomes a key tool in the pathways forward. Now, you may have seen in the last few days, Citi has issued a net zero report, and for our audience that sometimes confuses net zero and climate risk management, I'll just spend a second and say that while net zero is Citi's strategic imperative to get to net zero by a certain target, and we've come out with some interim targets for 2030, I think climate risk is probably more about climate's impact to all of Citi today and to all of the financial system. So they're both, I think, codependent and mutually reinforcing. But the way I think about climate stress testing is every bank has to start developing this new muscle as we think about what's needed on the other side and figuring out where are the vulnerable sectors and what do you do with them. Now, there are challenges. I'm sure it's a key part of your question is where do you see the big issues and challenges? But the ones we have done, we learned quite a bit, and yet we have to challenge our own biases within senior management, within what we show to our stakeholders, to our board, especially when it gets to 30-year scenarios. There are clients who are evolving, transitioning, or at least providing their own plans. Scenarios will change very quickly as climate patterns change. As you know, in this area, there is the non-linearity of data versus a credit cycle. You can take empirical evidence and repeat that. And here we are talking about very drastic scenarios, and you can pick whichever ones you like or choose a host of multiple scenarios and start saying, how do you start impacting change today? But to me, one of the bigger questions that we are also trying to answer is, how can we be a catalyst in helping the economy transition from this carbon intensity to a lower intensity? And what I mean by that is many of our carbon intensive sectors will probably need a lot more finance, a lot more transitional finance to support that decarbonization, because at the end, we also have, like our regulators have asked us, social requirements for generally uplifting and providing credit to all echelons of society. We also have to think about per capita consumption of energy in areas, as a global bank where we operate as probably the cheapest form of energy until there is a reliable source. So I think scenario design, planning, and stress testing are very important. They give us what I would say planning roadmaps of how we should think about changing the shape of the portfolio, how we engage with our clients, how we help them transition. But there is a lot of work to do, as this is such an early stage of this climate journey for all of us. So I would just say we're getting started. We've had significant regulatory dialogue around the world, in Canada, in the US, in the UK, and our global regulators everywhere else. And I think everybody's learning from each other through these early experiments of what this is going to mean. And I think scenario designing, stress testing are a key for this. I think the one more thing I would just say is, in this early stage, we've just about gotten, I'd say, a little bit of experience and expertise on regular stress testing. And you can see these from all the events that have happened in the last 10 years. Trying to take, and I think both Sharad and Teresa touched on this, trying to take climate variables and convert them into banking speak of how it will impact certain sectors or broader economies is still an art, right? Because we look for empirical evidence again of data, of impact, and we know it's there, but over a 30-year time frame, the pathways can be very broad. And so one of the jobs we have is also to try and narrow down those pathways to, what are more probable and take action accordingly. So climate scientists,
so Piyush,
is a very new theme.
In the wrong job, Piyush. You should have been a diplomat. You put things so elegantly with your last point. that you could easily, hold the top job at the United Nations. Let me see if I can put your last point a little bit more provocatively and see if I can, because I do hear it made, and that is, it's hard enough to do conventional forms of financial stress tests at banks. It's very hard to predict, let's say the COVID recession that came, or the global financial crisis. We can go through the litany of financial crises that were not well predicted by bank stress tests, and so, given the additional scientific as well as regulatory and market uncertainties involved in climate, in particular, when we talk about a global economy over the next 30 years, the range of uncertainty is so great that it's foolhardy to try to have the false precision of having stress testing now for a 30-year set of events with such a wide range of possible outcomes. Isn't this giving us a false sense of doing something when in fact it really is not providing us any significant information at all? And this is to some degree also pointed, of course, to our regulators. I asked for their comment as well to my cheeky observation, which has been made on the leader pages of The Economist, I must note, that this is as yet not a very useful exercise and may give a false sense of doing something useful when we're not. Piyush, you first, and I'll ask for Cheryl and Teresa for comments. Go ahead, Cheryl.
So Vijay, no, thank you. I was going down that direction, and I'd love to hear from our regulators. Look, third, you have to start somewhere, right? And so I can do a 5-year stress test, and I won't know what the pathways look like, and you may come with some suboptimal decisions with a 5-year stress test. Whether 30 years is a right number or not, I think the key is building a little bit of convergence in the scenario variables and how a banking system reacts to it. What you don't want in these early days is either for us or our regulators or our stakeholders taking 30-year stress test through untested models through data variability as conclusive, right? These are meant to give you a sense of direction. And I think in that you can pick your choices about what's the right tenor. We've done these on our energy sector. We've done these for our commercial real estate sector. And the answers are very divergent, where I think we're spending more time trying to convince ourselves of what the solution looks like, what the answer looks like, rather than acting on it. So I'm not against a 30-year stress test. I think you need to have long tenors because of the way climate will react over time. But I'll give you a couple of examples. How do you take a carbon tax variable inside of a stress test, especially for a global bank like us, in so many markets when there isn't a single carbon pricing mechanism? There are different carbon prices. Or the same assumption about changes of demand and supply in customer behavior, to that is, say, the use of oil and gas. So it's got its challenges, but I think we are at a precipice when these things are meant to be challenging, and over time, through innovation, through practice, and through more guidance and partnership, we will continue to evolve these.
Cheryl, what do you make of that?
Yeah, I mean, I fully take all of those points. They're very valid, and they definitely resonate from the feedback that we got from the financial institutions that took part in the pilot project for that the Bank of Canada and our Canadian bank supervisor did. I guess the important thing is that you need to just start, right? It's not going to be perfect when you first start, and I'm sure that banks would admit that the initial generation of models of CCAR stress testing that they came up with were far from perfect, and you've probably made a quantum leap since that point in time. They've got to evolve. But I mean, as Teresa said, we too are part of the Network for Greening the Financial System. Those models are out there. They're open source. They're available to take and to work with. The bank's own pilot is also available. It's open source. All the models are there. All the data is provided. So, I mean, I think it's part of the process. You just need to start somewhere and start to develop your expertise. I'd also point out, that okay, yes, they are 30-year scenarios, but I think it's becoming increasingly obvious as well that climate change is coming, well within that 30-year time horizon to, maybe over the next five to 10 years. And you're already seeing evidence that it is having an impact now. So, I think that, just because, they're modeled out to 30 years doesn't mean that you don't have any learnings from them.
Teresa, you've talked, in addition to the risks that need to be assessed, both physical and transition, also as the possible opportunities of a transition can also be observed. What are your thoughts on potential opportunities as well? And in particular, I want to, since we're talking about the financial sector, I want to put the observation out there, and I welcome any of you to refute me or tell me that I'm wrong-headed on this. But it seems to me that the financial sector is particularly well positioned to win no matter who wins or loses, in part because especially the larger banks tend to be hedged. If oil goes down, then they've got investments in renewables. And I think some studies of financial sector and banks exposure suggest that if you take the longer term view, the larger financial institutions generally can find exposure or shift very quickly to growing areas where they'll find profits to compensate for those areas that may be losing out in an energy transition. That's not true, for example, if you're a hydrocarbon producer, you're stuck with your legacy assets. It may be very difficult to diversify in that position, as we see some oil majors suffering. Banks are in a different kind of position, aren't they? Because they're essential enablers of multiple industries, and they often shift portfolios over time, and they deal with all sorts of risks: globalization risk, new technology risk. The rise of ICT technologies posed a legacy asset risk to them that they were able to shift lending to new sectors. Isn't this just a normal course of doing business for the big financial institutions that doesn't require a special set of analyses and that could particularly see them flourishing and not only suffering?
So I think what's really important to note is that this is a different set of risks to the usual risks that firms are dealing with, partly because it does run over decades rather than just years. So it goes beyond the business cycle. And I think the key point for us is that we really want financial firms to take a strategic approach to this. We don't want them to just walk into this risk. And so from our perspective as a regulator, we're obviously naturally focused on the risk side, but the flip side to risk is always opportunity. So it is for financial firms to find those opportunities and think about, what the transition means for them. Piyush made a really important point, which is that it's an entire economy that has to transition. It's not just about investing in green and pulling out of carbon intensive assets. It's about an entire economy shifting. And so I think the financial sector has a key role to play here in supporting that transition through stewardship, through active management, and kind of supporting that transition and making it happen. And within that transition, there will absolutely be opportunities. I think one thing that one point I wanted to make on the previous discussion is that I think what is really important in all of this is that it will be an iterative process. We're not going to get all of this right. Firms won't understand exactly where the risks and opportunities lie straight away, and neither do regulators know. And the same for scenario analysis on this, because it's new, just like stress testing, we'll have to find our feet and we'll have to iterate. And I think that's why it's really great to see how the financial sector and regulators are actually working together on a lot of this, having a lot of conversations. The regulators and central banks are coming together through the Network for Greening the Financial System. In the UK, we have set up a climate financial risk forum, which brings together banks, insurers, and asset managers, together with the Bank of England and the Financial Conduct Authority, to tackle the issues that the financial sector finds hardest and develop the right tools and develop the best approach to scenario analysis, for example. So we can really kind of help each other along as we develop this. And I think there's real merit in having a few different approaches and figuring out how best to do this before, as regulators, ultimately, we probably will decide about what we think is the right approach that we will continue to take going forward.
Piyush, I want you to weigh in on this. You've heard Teresa's eloquent argument as to why climate risk is different. But I want to put to you, since you're uniquely on this panel in the business of lending, your institution is. When I look across something like this S&P 500, an index of the big industrial companies in America, half the members that were there 20, 30 years ago aren't on that list anymore, right? It's this constant changeover, meaning there are losers as well as winners. That Schumpeterian creative destruction is the norm in Western capital markets and Western capitalism. What I do see over that 20, 30 year period is the big global banks like yours are still on there. In fact, they're bigger and stronger, if anything. And I would dare say, if we look ahead 30 years from now, many of the names on the S&P 500 today may not be there, but perhaps your company will be there. So I just want you to address that question of, is this conceptually and practically a different sort of risk or set of risks that is posed to your institution? And how do you, if you think it is, what do you need to do differently to build up the internal capabilities, for example, to deal with it? Or is it simply an extension of things you already know and how to do in other sectors for risk management? So you cut and paste and you just stick in climate data rather than other forms of risk data?
That's a phenomenal question, Vijay. So, transition is an evolving part of any economy, and you can see that in the changes that you've mentioned. But it's not very easy. I mean, climate will have a very different yardstick of transition compared to many other things of, for example, innovation. You're seeing that in EVs versus non-EV auto sector as an example. I think our clients have to transition. So that's when I think about a bank and I think regulators see the financial system, they're not seeing this solely from the lens of credit risk management. We've been very good at credit risk management generally, I would say, as banks, and we've got talent that was coached and developed to understand credit risk. But you're going to see climate come through the forms of our reputational risk. So our stakeholders are increasingly demanding more disclosure. In fact, the industry wants to do more disclosure. We just have to get to more common pathways or consistency of disclosure. And I know several of us are working together to try and raise those minimum standards that our clients should have, that banks should have. I think we will evolve. We won't get it as right all the time, but this is the phase where at least everybody's engaged in a dialogue. I was at COP26. I think many of my peers here were as well. And you could argue how successful or not COP26 was. But look what it did in terms of just generating a dialogue of global political leaders and regulators in where we have to go. So the way I think about this is there's going to be a new generation of clean tech companies. There's going to be hyper spending or money into this form of innovation that is needed. And the time it took to innovate new technologies of the past is going to be compressed by almost 50, 80%. So banks, how quickly can we evolve our own lending practices to lend to these sectors that need much more capital much earlier in their formation, as against the age-old credit version we had, which is you needed to see a steady business model with steady cash flows before banks could become lenders. It was really private equity or friends and family money. All of these business models are going to get questioned over time. And I think regulators are grappling with this as much as we are, is how do you redirect capital to this new clean tech? Because this is going to be the future if you really want to make a dent in climate change. And the last part, which is what I said in the beginning, I don't want to get any of us caught up in the crisis of activism around climate change. If there are serious carbon intensive sectors moving towards decarbonization, then I think it is responsible of us to work with them and give them more capital or bring in capital to decarbonize. Not everybody will make it to the other side, and you'll see this happening through M&A when there is capital destruction or capital creation. So it's going to be a very volatile journey, but the question is, do we do it in a disorderly way or do we do it in an orderly way?
You raise a really important point, that is the investment requirements and the changing nature, perhaps, of capital markets and how we fund innovation. If we are to have the raised ambition, that was a key theme of COP26, which we all watch very closely, we need to have much greater ambition in trying to achieve those goals below 2 degrees Celsius, hopefully towards 1.5 degrees. If banks are to get into this game of risk capital, as opposed to waiting for very stable, steady returns from project finance or later stage capital, that's going to change the risk profile. It's going to make it riskier for banks, for example. I wonder what our regulators think on this panel of the idea of banks having that more ambitious approach that would help meet the capital requirements. A recent report from the McKinsey Global Institute suggests to get to global net zero, we might need to have triple the capital spending over that period of time, over the 30 years at its peak. The money has to come from somewhere, and somebody's going to want to earn a return on it. That's the nature of how capital markets work. Are you comfortable with banks taking more risk in the interests of climate ambition, Cheryl? And Teresa, if you'd like to join in.
Raising ambitions is definitely important, right? I mean, we heard from Will Nordhaus in the run-up to COP, and he said, we haven't really broken the trend line with voluntary commitments at this point in time. So we're going to probably at some point get into a mix of carrots and sticks. There are definitely some profit incentives that are driving the financial decisions to get into climate, but climate financing. But I think that it's probably going to necessitate to have some movement towards more regulation. We've had some comments from our bank supervisor, for example. That we're probably going to have to move in that direction in Canada. Nothing has been decided at this point in time. And there are other regulators that are getting, that are starting to move in this direction as well. So it's going to have to be a combination, right? We can understand that, the need to transition, we can, cajole, various stakeholders in the private sector to move in the appropriate direction, but at the back, I think that there's got to be some push to say, if things don't move in the right direction, then we're going to have to up the pressure at some point.
Let me come to our Teresa. A quick point on that. We're running out of time, so please follow on.
I was just going to say, I think there's two different aspects to this. One is we need more information. At the moment, there's a lot of new products being developed in the market, and there's no standardization yet. We're missing a good taxonomy. So I think there's a lot to be done here to actually make this, to be able to measure the risk and to take a conscious decision on how much risk you're taking on. I think the other aspect is that we need to think about this slightly differently in terms of do we need longer term investment than we're seeing at the moment? Do we need to see a bit of a change in how the financial system works exactly, as we have done in the past? So this wouldn't be a new thing, but do we need to think as regulators creatively about the future direction of the financial system, how it will evolve in order to tackle this challenge?
Does anyone have a quick thought on the best thing that we could do to try to harmonize approaches across countries? There do seem to be a diversity of approaches. What's the most promising thing that you see for trying to coordinate efforts towards climate scenario analysis? Or is it hopeless? Is it going to be a messy world? Payush, go ahead.
I can start, and I think it's probably a statement of the obvious, but this is an area where regulatory convergence is so primed to work together, right? Because we've got in the banking system the Basel Committee, and then the rules get adopted and localized by different regulators. As you think about the ubiquitousness of climate change everywhere, some countries more affected, some less, but everybody's being affected. How do you try and converge in scenarios that, rather than spending a lot of resources on very tailored stress tests or scenario designs for different countries, can regulators work together on a common taxonomy, a common stress test for those branches or banks in their countries? But really usage or being more efficient in terms of the usage of resources and understanding the impact. To me, I think that would be the number one thing I would ask, and I think it's gradually happening on this side with the regulatory prescriptions.
Any final words from? Yes, Teresa, you get the last word, please.
I would actually argue that a lot of this is already happening. I think regulators and central banks are talking a lot to each other through the network for greening the financial system. And there are a lot of standard setting bodies where climate is an active part of the conversation. In Basel, all the regular standard setting bodies are picking up this conversation. So I think there's a lot of lot of that happening. But the other point is, I'm not sure we're at the point where we want to make everything the same, because I'm not sure we've quite figured this out yet. So I think there's a lot of value in different approaches in terms of testing what actually works best, learning from each other, learning from each other's mistakes, and then picking the best solution before we all move forward in the same coordinated way.
But Teresa, that's an optimistic note to end on. We're in a phase of learning by doing, and hopefully, to Piyush's suggestion, we'll move towards some form of global coordination of what works as we grapple with this grand challenge. I want to thank my speakers for giving us the deep insights into this topic and for getting us going on what is incredibly complicated but vital area of thinking about the energy transition. And I also want to thank our audience for joining us today. Please stay tuned for the next session, which will be joining shortly.